Thank you, one. Thank you all for joining us at this my final webinar for the week at Epic Street. As always, I thank the fine folks at Epic Street for inviting me to conduct this event. And let's get right into it. First of all, let me remind you, this is not, I'm not an alert service. I'm not going to make trade recommendations during this event, but I will provide some technical and fundamental analysis. We'll look back at the trading day that's just passed behind us. We'll take a look at Thursday, what happened in the currency markets. We'll take a look ahead, especially at the news calendar, to see what Friday may have to offer. And along the way, I'll carve out time to answer as many of your questions as I can possibly address. Keep in mind, when it comes to addressing questions, I am not known for short answers. I tend to give lengthy, detailed answers. If anything, sometimes it's a fault of mine, but I seek to help, and I'm a quant. I'm sort of a recovery nerd. I'm a nerd by nature, so I tend to give detailed answers in the hope that that can help you better learn and apply whatever I explain to your trading. Hopefully, it'll help your trading in the future. So the general format is this: I take a look back at the particularly the New York morning session, but I'll touch on at times the London morning session as well. I'll highlight some trades, or if nothing happened, I'll even talk about that and why maybe nothing happened. And again, we'll take a look at tomorrow in the news calendar and maybe talks about some ideas as to what could move the market. Maybe sometimes there's factors that aren't on the news calendar per se, but it could still move the currency markets, or not just the currency markets, broader financial markets. So we may talk about from time to time about stuff like that. By the way, I conduct a similar webinar to this one, 3 other days in the week, Monday, Tuesday, and Wednesday, about an hour after London close, starting at 1 p.m. New York time. This is the honor of the 4 webinars I do with Epic Street each month. The honor, and then it's only that it starts at Asian Open instead of after London close. Anyway, let's get started. The highlight news events of today's trading session was really central bank rate decisions. First from the Bank of England, second from the European Central Bank. Pretty commonly, those two central banks have a rate decision virtually every month, usually in the first Thursday of the month. This month, it was actually the second Thursday of the month. The first Thursday of the month would happen to be the 1st of September. And so this month was a little bit odd, and it was actually the second Thursday of the month, and actually the Thursday after the release of the U.S. non-farm payrolls report. Nevertheless, we had 2 rate decisions, one from the Bank of England, one from the European Central Bank. Neither central bank was really expected to do anything, and neither one did. So that wasn't a surprise. But nevertheless, we did get some trade oil price action in response to both central bank rate decisions. Let's start real quickly with the Bank of England rate decision. I'm going to switch to a view showing 3 different charts for the British pound U.S. dollar currency pair. Let's take and bake on the silver currency pairs right now, by the way. I'm going to focus mostly on charts without indicators. That's preferred favorite pastime of mine. I'm going to look at a 15-minute chart here. I've got some lines in this chart, but I'm tempted just to remove some of these lines and keep a simple focus on basic price action. What we had was this. I was talking in the live class at Epic's Bootcamp before the Bank of England rate decision about this. There's, given the recent economic data coming out of the UK lately, plus the signs of a broader global slowdown in other developed economies and developing economies, there's been some increasing chatter about more central banks not only stopping rate hikes if they've been hiking rates, but in some cases, some central banks actually pursuing more easing policy. In the case of the Bank of England, in the recent being the past several months, up to about the past year, the Bank of England has had some voting members on the Monetary Policy Committee. That's the group at the Bank of England that decides on monetary policy on behalf of that central bank. About 2 or 3 voting members, up to 3 different voting members at the MPC, have been favoring, especially earlier this year and late last year, actually favoring a rate hike, raising interest rates to help tame inflation in that country, which has been on the rise, particularly last year and earlier this year. Well, I don't know how many of you noticed it, but some things have changed recently. one of the things I discussed at FX Bootcamp before the rate decision today, I was reviewing the MPC meeting minutes. I don't know how many of you use that, but that's a great source of clues as to what the Bank of England may do. And actually, I should back up even further from that. As many of you know, but some of you may not know, one of the key drivers in the currency markets of price action, of sentiment for or against a particular currency, in this case the British pound, one of the key drivers of a demand for or to buy or to sell a currency is central banking policy. Again, central banking policy. Some central banks are lean more towards a hawkish stance, where you have rising inflation. In the cases we have rising inflation, particularly as it's accompanied by economic growth and hopefully sustained economic growth, you can have a central bank that's raising rates. A growing economy with a central bank raising rates tends to fuel a stronger currency. If you have just the opposite, a weaker economy, when a central bank is trying to stimulate a weak economy, it lowers rates. And some form of accommodative policy in the form of either lower rates or, in the case of what the Bank of England has done in the past couple of years, is to pursue a so-called quantitative easing policy, much like the Fed, where the Bank of England for a while there was acquiring government bonds, otherwise known as gilts in the UK. The Bank of England has acquired something like 200 billion gilts over the course of their own quantitative easing program. And again, earlier this year, the Bank of England was seemingly leaning more towards raising rates, lower rates. I believe it's 9 MPC voting members. Again, the MPC who decides on monetary policy on behalf of that central bank. Of the 9 MPC voting members, at one time, I think it was about first quarter this year, at one time we had 3 different voting members saying, let's raise rates right now. Let's raise rates right now. And the prospect of a rate hike from the Bank of England, especially if a rate hike from the Bank of England coming before a rate hike from the Federal Reserve, that gave a lift to this currency pair. In fact, I could show you this on the daily chart. Actually, let's go to the weekly chart. Yeah, you might notice that earlier this year we had a rising pound dollar. Now, part of that was QE2, the QE2 from the Fed, the Federal Reserve, was doing more quantitative easing, whereas the Bank of England not only was no longer doing quantitative easing of its own, but also there was rising prospects of a rate hike by the Bank of England. So that gave a lift to this currency pair earlier this year, and it's even to some degree later last year. Now, recently, with increasing weakness in the UK economy, maybe due in part to some austerity measures put in place last year by the UK government, increasingly this year you've had a case, especially in the past few months, you've had a case where the prospect of the Bank of England raising rates was lowering, was dropping, as the UK economy was getting weaker. The growth wasn't quite there. Inflation was expected, according to many MPC voting members, inflation was expected to moderate over time. And so, like I said earlier, at one time we had 3 voting members saying, let's hike rates now. At the last MPC meeting earlier last month, no one voted for a rate hike. The decision to keep rates as they are, the main bank rate for the Bank of England as it was, that decision was unanimous. No one voted for rate hike. So that, plus, again, the increasingly weaker economic data, not only in the UK, but especially in the broader developed world, that has raised expectations of possibly some easing by the Bank of England. Some further easing, maybe more QE, maybe some other form of so-called easing policy to help stimulate the UK economy. And again, the prospect of that has weighed, I would argue recently, weighed on the British pound. So we approach today with with the prospect of the Bank of England probably not likely to raise rates, especially based on the MPC meeting minutes for last month's MPC meeting. Those minutes didn't make it obvious that the Bank of England was going to raise rates today, but at least the prospect of lowering rates, or not lowering rates, but the prospect of a QE was on the table. what I told the live class before the rate hike, before the rate decision today was that if there's one central bank, if there's one major central bank, you're talking about the Fed, the ECB, the Bank of England, of those three major central banks, if there's one central bank that's more prone to surprise the market, it's the Bank of England. The Bank of England, by far, has been more prone to surprise the markets than most of the other major central banks. The ECB, in my view, by far the most transparent, the one most likely to signal a policy change before it happens. Fed somewhere in the middle. It's not, they're not totally transparent, but nor are they, keeping their cards that close either. So anyway, what I saw was this. Number one, let me back on a 4-hour chart. Number one, if you look in the lower right-hand part of this chart, I'm actually going to go to a daily chart instead. What I discussed in live classes, we had the cable reaching earlier today, as I saw, 3 prospective sources of technical support in the 5920 area. First of all, the lows of the past 2 days were near 5920. Secondly, if you look at a trend line going back to late last year, if you connect the lows from late last year with a swing low established in July and extend that trend line forward in time, the black uptrend support line comes close to 5920. Plus, and this is the kind of trend line that I think, sorry about that. Boy, that guy's going to hear from me. I think he knows I'm doing a webinar. I apologize for that. Just trying to turn the cell phone down. Plus, this orange trend line on this chart, this is something that I think a lot of traders don't always look for, but it can have an influence on price action. It's one of those seemingly more obscure trend lines for some traders where sometimes it's resistance and sometimes it's support, or vice versa. In this case, the orange trend line beginning with the late April high, that trend line was resistance going through about mid-June, and then it was support. Seemingly, it was at least part of the reason for support found by this pair around August 10th, August 11th. So notice the convergence here of 3 prospective sources of support. Visual support, as confirmed by the lows of the past 2 days, also the lows from late June. You had the uptrend support line, and you had this orange trend line, all converging in the 5920 area. So you could argue that there was a technical case for cable to rise today anyway. So you saw more bullish and bearish price action leading up to the rate decision. Then, and as the rate decision was approaching, what I told the live class was, if the Bank of England does anything, if anything, what you'll see in terms of reaction is probably positive. A positive for the British pound, if only because if you look at price action over the past few days, it seems we've seen that the British pound's been under pressure. Now, of course, the dollar's been firm too, so it's not totally a British pound story. But the pound, this pair has been falling, maybe at least in small part due to some increasing expectations the Bank of England may actually do something. So the risk was that there was a possibility the Bank of England might do something, but probably a low possibility. And the fact they did nothing today, in my view, prompted at least some short covering on the British pound, which meant up for this pair. So going back to the 15-minute chart, we had a little rise after the Bank of England rate decision was revealed and showed no change. A pull back to the 59.50 area. Actually, correction me. The rise in response to the Bank of England. Let me zoom in on this chart a little further. The biggest green candle you see on this chart, that's the response. That's the response to the Bank of England rate decision. And you can see, and I'll highlight this with a couple of arrows, a case of role reversal here. I've even park a horizontal line in there to make the point. And it's interesting that horizontal line not too far from the 1.60 psychological level. So there's definitely a technical case for a long. If you weren't long before the Bank of England rate decision, long around the 59.20 area during the early to middle part of today's London session, there was a case for a second chance long on this pair, just below 1.60 the psychological level. And cable made it up to 60, 75, 60, 80 area and then dropped from there. So that was one trade during today's New York morning session, that is, a cable long. The other scenario, the other trade that we spent a lot of time talking about today during the New York morning session was on the euro. I mentioned earlier 2 rate decisions, one from the Bank of England, one from the European Central Bank. So we are watching the euro as we approach the 8:30 a.m. New York time, and because that was the scheduled start of the press conference. Now, it's worth noting that when it comes to these 2 central banks, the Bank of England and the European Central Bank, the Bank of England, when it comes to rate decisions, it will announce its rate decision typically at 7 a.m. New York time on the day of a rate decision, again, typically a Thursday. The Bank of England traditionally will have no press conference after the rate decision, and only if they change something, usually only if they change something, will they issue some sort of statement. So if there's no change, in this case, no change to the bank rate, no change to the quantitative easing program, they issue no statement. Or if they issue any statement, it's a very, very minor one, very, very brief one. By contrast, by the European Central Bank, after every rate decision, they will conduct a press conference. And traditionally, if you look at price action in response to the rate decision, which in today's case, and almost every time there's an ECB rate decision, the rate decision is released at 7:45 a.m. New York time. Rarely will the euro move in response to that. Sometimes it happens, but it's very, very rare that you see a move on the euro in response to the rate decision itself. And I would attribute that in part to the fact that, number one, the ECB, Trichet, specifically the European Central Bank president, during his press conference, tends to reveal a lot of clues about what monetary policy may be like moving forward. And the fact of the matter is, as I see it, the ECB largely pretty transparent, pretty good at providing clues as to what will happen. So the market, rather than respond to the rate decision and speculate as to based on a change or no change by the ECB, rather than speculate on what can happen, they wait to see what Trichet has to say. And to say, at least as often as not, will give some clues as to monetary policy moving forward, and that's when the market moves. If and when there are clues, either from Trichet's discussion or maybe some other data from the ECB that's sometimes published during that ECB press conference. In today's case, let me go over to the Euro USD here. In today's case, we had the ECB staff reveal its updated projections for Eurozone GDP growth through next year, and also inflation for the Eurozone. And what we saw was this: a few minutes after the start of the ECB press conference, where Jean-Claude Trichet was speaking at the ECB headquarters to the local media there, a few minutes after that, the ECB staff revealed its updated projections or forecasts for GDP growth in the Eurozone for this year and for next year, and also for inflation. As it turns out, their forecasts, and this probably won't surprise many of you, their forecasts for growth in the Eurozone were lowered for next year. Forecasts for growth, for GDP growth, lowered for next year for the Eurozone. As I saw it, that's when the euro got going. That is, euro selling got going. You should now see a 15-minute chart without indicators for this Euro USD currency pair. Now, we did talk about, before the ECB press conference began, we talked about a prospective short in the 1.4060 area. I've got a horizontal purple line near the top of this chart, and that represents that 1.4060 level. And you should be able to see my cursor in the upper left-hand portion of this chart. You can see where the euro seemed to respect that 4060 level during the London morning session. So that area was generally support during the London morning. And then during the early part of my coaching session, basically as the sun was rising over the U.S. East Coast, the euro dropped below that horizontal purple line. So this was a simple case of, let's say simple, it doesn't always work this neatly, but in this case, this was the basis for a trade plan here. The basis for a short was a role reversal. Anybody ever heard of role reversal? We refer to role reversal quite often. Let me type that in to make sure that the terminology is understood. Role reversal. Oops, let me type it again. Role reversal. In this case, a level which was support during the London morning session became resistance in the early part of the New York morning session. So there was a case for a short around 1.4060. Again, right around the open of the New York session, actually about an hour or so before that. Now, was there risk in this trade? Yes. Now, of course, there's always risk in every trade, right? But in this case, there was a more added risk today because of the ECB press conference and, the idea of, what if Trichet were to surprise the market and sound a little more hawkish? Hawkish meaning more concern about inflation, and also hawkish might mean that the ECB staff might not have lowered its projections for Eurozone growth. Again, the ECB has a reputation for being, one of the more hawkish central banks out there, which is one reason why the euro has been supported. I've fielded many questions about, why is the euro USD so relatively high? Why isn't the euro getting punished? Well, part of it's because of Fed policy, Federal Reserve policies, extremely accommodative, more accommodative than it is in the eurozone. And secondly, the ECB, that's an inherently hawkish central bank. They're much more focused, much more concerned about inflation than other central banks. So that's that's at least one of the reasons why the euro has held up against the dollar. But anyway, so there was a case for a short in the 40-60 area before the ECB press conference began. Now, what I discussed in the live class before Trichet started speaking at the headquarters at the ECB headquarters in Frankfurt, what I said was that if you look at the economic and financial markets data coming out of the eurozone lately, it wasn't a stretch to assume that Trichet was going to be at least less hawkish, in other words, less concerned about inflation, and maybe even more dovish, meaning more concerned about either growth in the eurozone or specifically maybe about the health of the European banking sector. As many of you may know, European banking stocks just got punished early last month. And, of course, many of the Eurozone banks are exposed to sovereign debt throughout Europe, and there's still signs of stress in the European banking sector. So bottom line, and there's other things that Trichet said, but one of the key things I saw that he said, and it seemed to prompt the selling in the euro, was that when the ECB staff projections for GDP growth in the Eurozone, especially for next year, were revealed, and those projections were lower for growth next year than the projections were as published back in June by the ECB, that's when the euro starts selling off. And I don't show it here, but there is a weekly S2 pivot point in the 39.45, actually 39.50 area, a weekly S2 pivot point. And my cursor is right next to a swing low where that weekly S2 came into play. And the trade setup we talked about even after the bounce of the weekly S2, the trade setup we talked about in the live class before the end of my coaching session was a short in the 1.40 to 1.4020 area. Now, I've got a couple horizontal lines in this chart, one at the psychological level 1.4, another on a blue line. So a black line at 1.40, a blue line at 1.4020. Now, the idea behind the 1.40 to 1.4020 is this. Naturally, 1.40 is a psychological level. Psychological levels tend to attract greater tension. Hence, a pullback, in this case, in rising price, could find resistance at a nice round number psychological level. That does tend to attract greater tension. Another thing you could do to make the case for a short between the 1.40 to 1.4020 area, you could draw a fib study of the main move down, which the 110 pip or so move down after the ECB press conference began. Now, I've just applied a fib study of that move down, and actually I just drew the fib study backwards. Hang on a minute. Still so used to drawing my fibs on GFT. Where on the GFT fibs I haven't set it. There we go. I see the 61. It's really hard to make out, but it's in the upper middle portion of this chart. The 61.8% fib of the move down from the post after the ECB press conference, the high following that press conference was around 40.60. The low around 39.45 or 39.40. The 61.8% fib retracement level, that move down rests at about 1.4017. Again, within that 20 pip range between 1.40 and 1.4020. I don't show it in this chart, but at the time, there was also an hourly 5 EMA near 1.4020. And if I back out on an hourly chart, if you look at price action near the middle of this hourly chart, I see several swing lows and one swing high over the course of Tuesday and Wednesday's trading. Several swing lows and a swing high looks like in the early part of, maybe the early part of Tuesday's Asian session or something like that. Several swing lows and one swing high, all within about 10 pips of the 1.4020 level. Again, 1.4020 represented by the horizontal blue line on this chart. So my point is this, the 1.4020 area had some recent history to it. So you got a 20 pip zone defined by a psychological level and a level which seems to have influenced price action in the past couple of trading days. A 61.8% fib of the post-ECB press conference move down. And again, I don't show it here. There was a 5 EMA from the hourly chart in the vicinity at the time. I guess I should do that. And I've got my cursor next to it. I've expanded the hourly chart with daily pivot points, and my cursor is next to the hourly 5 EMA, and you can maybe just be able to make out where that came into play. So the idea was on trader on the Euro USD was a short at or near 1.4020, targeting the weekly S2 pivot point. And that trade produced something approaching about 70 pips. And that was those are the highlights as I saw. Actually, I can throw in one more for good measure. One more trade that materialized, a logical technical trade that materialized during today's New York morning session. I'm going to go back to my market overview showing multiple currency pairs. There's the Swiss franc for a minute up here. I'm expanding the chart for the pound Swissy currency pair. Now, as many of you know, on Tuesday, the S&B, the Swiss National Bank, the central bank in Switzerland, announced its intent to do whatever it can. It's made a pretty bold commitment to do whatever it takes to put pressure on the Swiss franc and limit Swiss franc appreciation. In other words, the Swiss National Bank has established a target floor for the Euro Swissy currency pair at 1.20. It's committed to defend that floor virtually at all costs. So ever since then, the Swiss franc has been broadly weak. Of course, there was a huge sell-off in the Swiss franc on Tuesday during Tuesday's London session. But since then, the Swiss franc has been generally drifting, weaker and weaker and weaker. And during yesterday's New York session, in yesterday's New York session video review, I talked about a range trade. This pair, the pound Swissy, you can just make out in the lower left-hand portion of this chart, the pound Swissy was trading in a range. And I defined that range during yesterday's New York morning session, the range on this pound Swissy currency pair, between about 1.3680 and 1.3750. So you had a roughly 70 pip range, a 70 pip range that was tradable during yesterday's New York morning session on the pound Swissy currency pair. Well, you'll notice in the lower middle part of this chart that during today's New York morning session, the pound Swissy broke out of that range. Again, probably due at least in part to broad British pound strength following that Bank of England rate decision. So let me go back to the 15-minute chart and zoom out on that chart a little bit here. So I saw two different opportunities on this currency pair to take a shot long. One, I've got my cursor next to this. One was essentially the retest of the top of that trading range defined by price action yesterday. So in other words, in this case, take a long at a retest of the 1.3750 level, again defined by the horizontal blue line in this chart. And there was a second chance, and this is similar to what I described earlier. You remember the example of roll reversal I described on the Euro USD short trade earlier? A support was broken, and then a retest of support at 1.4060 on the Euro. Well, in this case, the roll reversal was a change in roll of a level from resistance to support. I've got a horizontal orange line at 1.3820. That seemed to be for over the course of about 30 minutes, over the course of two 15-minute candles, that seemed to be resistance. You can see my cursor near the wicks of the tops of two 15-minute candles there. That was resistance for a time. Well, we broke above resistance. You can see the green candle here. By the way, that green candle I'm pointing to now, that's a very bullish candle. Not only because of the size of the candle, but also because of lack of wicks. The lack of wicks on that candle. I think I usually mispronounce the term, but it's called something like a Maribozu candle. Can anybody confirm that? A Maribozu candle? I may be mispronouncing it terribly. Anyway, that's a very bullish candle, both in size because it's bigger than most of the other candles before it, also because it lacks wicks. So again, bullish move above recent resistance. So what was resistance before became support. So there's your long, a long at or near 1.3820, a retest of recent resistance. And of course you could have fibbed it too. That looks like a 50% fib of the recent move up, especially the move up generally defined by that big green candle. And we almost got to 1.40, but didn't quite make it. So there was a good 120 or so pips in that rally during today's New York morning session. Maybe the toughest thing about that trade was, that setup came together right at the start of the European Central Bank press conference. But the argument there could have been that, and rightfully so, that the ECB press conferences rarely move up a pair like this. So I discussed 3 trades, 2 on some fairly significant major currency pairs, pound dollar and euro USD. 1 on a pair that some of you may be considered a little more exotic, but if you're not looking to trade at all the Swiss franc pairs, I consider you take a closer look at them. Spreads are reasonable on those pairs. Plus, they do trade just every bit as technically as the major currency pairs do. And it's not crazy to be considering the major move made by the Swiss National Bank on Tuesday. Not crazy to look for some sort of a carry trade opportunity on one of those Swiss franc pairs. Maybe you don't pick a European currency compared to the Swiss franc. Maybe you pick a commodity currency like Aussie or the Canadian dollar or the Kiwi dollar or something like that. Well, that's a look back. Look ahead. I'm going to open the FX Streets calendar. Let's see what's on the news calendar for tomorrow. You're going to have a little pause in the action, so if anybody has any questions, now's a great time to ask them. Thank you, Michael. Yes, I knew I knew the spelling. I just didn't know the pronunciation. I'm from the Midwestern U.S. and I just can totally butcher pronunciations of even remotely foreign words. Caused a few chuckles amongst our members from time to time. While I'm waiting for the FX Street, the website to come up, and by the way, it's not FX Street's fault. I had to open a web browser, and then now I'm queuing up the website, and then I'll queue up the actual the calendar on the FX Street website. While I'm waiting for that to queue up, as many of you know, the U.S. President Obama delivered a speech, a jobs plan. That speech was started at 7 p.m. New York time about 90 minutes ago. He finished the speech about 45 minutes ago, about 50 minutes ago. I have yet to really review the speech and any response to the speech by Republicans and such, but at first glance, what I do know is that the jobs package, I believe he proposed during his speech, the jobs package was about 50% bigger than what many thought. I believe some analysts were looking for a $300 billion package, a $300 billion jobs package, and what he proposed during his speech, nearly 2 hours ago, was a $447 billion jobs package. So, at first glance you're thinking, well, a little more stimulus than expected. Now, the thing I think honestly haven't looked into and figured out is, is what Obama has proposed, is it even passable? Now, it's all fine and good for the leader of, in this case, of the U.S., to recommend some form of stimulus to help stimulate the jobs sector in the U.S. But can it pass Congress is another factor. And this is something that Europe has struggled with for a while, and U.S. isn't doing much better. We're talking about political gridlock here in the U.S. There's such a wide gap in thinking and beliefs in terms of what should be done to sort of fix the U.S. economy, as if it's such a big complex economy can be fixed easily. But anyway, there's as many of you know, there's been a lot of how do I put it? Yeah, a lot of political gridlock here in the U.S. By the way, this sort of gridlock not uncommon when economic times are bad. There's a sense of urgency that people want to fix things, and some are looking for short-term fixes, some are looking for long-term fixes. And if you ask 10 politicians what should be done, you might get 11 different answers. Remember, each politician is going to try to cater to their own constituency, and each constituency, each state or whatever is going to have different kinds of citizens or workers with different kinds of needs. So it's and of course we have some problems in the U.S., not just in the U.S. but other countries, certainly, particularly Europe. But plenty of problems here in the U.S. that are such big problems that have been building and building for such a long time and cannot be fixed easily or quickly. So anyway, plenty of political gridlock here. And my point is this: in terms of sustained market response to this Obama jobs plan, this jobs package, I'm not optimistic. I'm not optimistic about any sustained reaction to this jobs package. I'm sort of in wait and see, and honestly, I'll be reading into this after this webinar is over, and of course, maybe even sometime tomorrow and over the weekend. But I'm not optimistic because of the political gridlock we've seen thus far. I don't know how many of you know it, but there was a real debacle in Washington D.C. Late July, early August with the whole debt ceiling issue. There was just it was just a mess. It was just a mess. Something that should have been fairly simple in the past became a real political mess, a real political nightmare. And then there was even some unusual call it conflicts in scheduling just to get this Obama speech set up for the speech that started nearly 2 hours ago. So anyway, I got it. At least I'm not that optimistic. And since the majority of the market not optimistic that anything meaningful can be passed by Congress that effectively or that quickly. Again, based on the recent political gridlock in Washington. And beyond the bigger jobs package and what many analysts expected, one comment that Obama made during his speech that caught my attention was that he said something about a lot of what he recommended in this jobs package are the kinds of things he's already recommended before. So I get the sense that I haven't researched this, but I get the sense that he didn't really offer anything dramatically new. So, if there's nothing new there, if there's one of the things that moves markets is new news, new forms of sentiment, a real game changer. I haven't sensed yet that anything U.S. President Obama has proposed is a game changer. So a combination of, recent political gridlock in Washington plus no obvious game changer that I can see. And thirdly, I would add that even before Obama became president, as this global financial crisis was unfolding in late 2007 and 2008, and up to the time that when prior U.S. President Bush finished his tenure and Obama came into office, during that time when Bush was still president, maybe it's a reflection of Bush more than anything else, but it was rare to see. It was rare to see back when the financial crisis was really unfolding. It was rare to see the markets show a significant response to comments by the U.S. president. The two officials that have seemed to have influenced the most price action in markets, if you're looking for two officials to pay attention to, one's Federal Reserve Chairman Ben Bernanke, another, and although he hasn't moved the market much lately, another is potentially Treasury Secretary Timothy Geithner. So remains to be seen whether or not the market can will do anything with this new jobs package proposed by U.S. President Obama. And I've certainly got Epic Street open now, so I'm going to go to the Epic Street calendar, and we'll take a look at tomorrow's calendar, see what may be coming up. And I've got 5 minutes left in my scheduled session here, so again, while I scan the calendar and mention anything that I see on the calendar that could be have an influence on price action from now to the end of the trading week. If you have any questions or if you have a question you've posted earlier that I may have missed, please feel free to repost it. China CPI. I see a China CPI figure coming out during today's Asian session. Those figures from China haven't influenced the market as much this year as they did last year. But China's CPI number has potential to influence the markets, especially during today's Asian and London sessions. So the idea is this: if China's CPI numbers come out higher than expected, if there seems to be higher year-over-year inflation in China than what was expected or forecast, that could suggest that the Chinese central bank is going to tighten policy more, raise rates or raise reserve requirements or do something to limit lending by the state banks in China. And that could prompt a sort of risk-off scenario, maybe weakness in commodity currencies, particularly the Australian dollar, maybe some firmness in the dollar or yen or even a Swiss franc. Although I would not expect a whole lot of Swiss franc weakness in the context of the Tuesday announcement by the S&P to put a floor into the Euro Swissy. So anyway, the CPI figures out of China haven't influenced the market as much recently, but a surprise number there could move the market. Oh, in the opposite scenario, if we get lower than expected inflation out of China, that could mean the Chinese central bank might put the brakes on any further tightening policy. That may be perceived as a positive, as sort of a risk on for financial markets. In terms of currencies, that could suggest some Australian dollar strength if we get a notably lower than expected CPI number out of China. CPI numbers out of Germany, it doesn't tend to move the market much. PPI, Producer Price Index out of the UK, don't expect much out of that. Canadian employment figures, that could move the Canadian dollar. At 7 a.m. New York time during my next coaching session at FX Bootcamp, we're going to see some Canada jobs figures. That can certainly affect the Canadian dollar. That's it, though, really. Don't see anything else. And I would add to that, just simply watch Europe. As I've been saying for what seemed like several weeks now, as I saw Europe was a key driver of the global financial markets, not just currencies, in August. And I would keep an eye on Europe, these days until things change as well. So when I say keep an eye on Europe, I'm watch the DAX, the main German stock market index. Maybe watch secondarily the CAC 40, the main French stock market index. There's some select big banks in Europe you might watch. Bond markets. Watch the Italian 10-year government bond yield, Spanish 10-year government bond yield, even German government bonds. If you see, actually, I think it was just today, or just yesterday for many of you, the yield on the 10-year German government bond, otherwise known as the Bund, hit a record all-time low. Unusual to see German bond yields even lower than the U.S. 10-year, than the equivalent denomination of U.S. Treasuries. And that could be one reason, by the way, why the euro has been under increasing pressure. In addition to factors like, risk-off mood and of course now the less hawkish ECB, which we just saw today. But on top of that, if you just look at bond yields, compare the 10-year German Bund yield to the 10-year U.S. Treasury T-note yield, the fact that U.S. yields for now are a little bit higher than German yields, that's a dollar positive, if anything. And I just noticed the time. That marks the end of my webinar. I'm not so stuck and attached to ending at the scheduled time, but I do want to be respectful of everyone's time. I especially want to be respectful of the time contributed by the fine folks at Epic Street. Should take this opportunity to thank everyone at Epic Street who's helped make this event possible. I really enjoy doing this event and looking forward to doing more in the future. Again, I conduct these webinars 4 times a week after London close on Monday, Tuesday, and Wednesday, and at this time, starting at 8 p.m. New York time on Thursdays. Again, the start times for Monday, Tuesday, and Wednesday webinars, Monday, Tuesday, and Wednesday, 1 p.m. New York time, Thursdays at 8 p.m. New York time. Again, thanks to everyone who's attended this event, and again, thanks again to Epic Street. Have a great day, folks. Good luck tomorrow with your trading. Cheers.